Great questions.
22 seconds away from the opening bow this morning. Good morning. Not much of a good morning if you're long this market. We're negative 1.3% on the S&P. Futures negative on the Nasdaq 100, down by 1.76% on the S&P this week, heading towards a third week of losses on the S&P 500. Longest weekly losing streak of this year so far. There's your opening bow. Switch on the board and get to the bond market. Post PCE. Upside surprise coming in hot. Inflation in America, you know the story. Yields up 7 basis points, 394.91 on a 10-year, and coming really, really close to 480 on a 2-year. Yields higher at the front end of the curve by 10 basis points. Bit of dollar strength out there. Euro dollar 105.42. Euro dollar negative 0.5%. Keep an eye on crude 74.62, down about 1% there. About 20 seconds into the session, equities down as you might expect. Following that data out about an hour ago on the S&P 500. We're down by 1.2%. On the Nasdaq, we're down by 1.6%. Mohammed, great to have you with us to work through some of this. What a move in the bond market to see the 2-year so close to 480. Subhadra Rajappa was on the show with us earlier this morning with Tom and myself from SocGen. She said there was asymmetric risk around the bond market. There's more downside than upside to yields. Do you agree with that?
I think we're getting more balance, actually, John. I mean, we've moved a huge deal. 4 or 5 weeks ago, people were talking about going through 4%. We got to 4.02, 4.03. Yeah. So we've moved a huge way. So I'm not sure. I think it's more balanced now than it's been before. The one thing I don't know, and that's worth you pursuing, is what's going to happen to flows. We opened the year with the consensus that you want to be in bonds. People went into bonds. We had a lovely rally. It went too far, too quickly. Now we fall back. The question is, will people put more money to work, or will people worry that bonds are not risk mitigators? And that I don't know. So it's really important to get the technical call right at this point.
Well, there's a lot to unpack there. You and I went back and forth on this a little bit earlier this week, and I was basically asking you whether you think this is a once-in-a-generation opportunity to lock in yield for as long as you can, or a new generation of higher yields. Which one is it?
And what did I tell you? I said, I don't know, John. I've never seen such uncertainty about growth, inflation, and policy. I've never seen this before.
So for you personally, do you take a 6-month at 5%, 2-year?
So for me personally, I'm still very barbelled. I do take interest rate risk higher up in the quality spectrum, and I take it not just short term, but longer term too. But then I look for bottom-up name selection where the mistake is recoverable. I think people don't ask the question enough. Are mistakes recoverable in this environment? Default is not a recoverable mistake. Many other investment mistakes are recoverable. So you've really got to build your portfolio from bottom up, not top down.
Can we talk about reinvestment risk just briefly? If you took a 6-month at 5% and then found yourself in 6 months looking at fixed income, have you got any idea what that might look like in 6 months' time? Just how big is that reinvestment risk around that story?
I don't, and that's why I'm not taking it just in 6 months. That's why I'm spreading it along. I think, as I said earlier, I can sit right here and give you 3 plausible scenarios, and I cannot tell you with a high degree of confidence which one you should bet on. That's unusual.
That's where we are right now. Yields up 10 basis points, really, really close to 480 on a 2-year. Your equity market's down and down hard, up 10 basis points at the front end of the curve. One stock to watch at the open, Boeing, pausing deliveries of its 787 Dreamliner due to a documentation issue. The company saying this: while near-term deliveries will be impacted, at this time we don't anticipate a change to our production and delivery outlook for the year. Abby has more. Hey, Abby.
Hey, John. Well, the stock is certainly down hard, heading to its worst day of the year since December. At one point at session lows, down almost 5%. At that point, on pace for the worst day since October. So there is definite bad news here, even though analysts are saying that it could be short-term along with the company. But essentially, they are halting their 787 Dreamliner deliveries on a fuselage part review. The problem stems from an analysis error by a supplier related to the 787's forward pressure bulkhead. Now, Boeing discovered this issue in certification paperwork provided to the FAA and then notified the regulator. But to your point, or to the company's point, point, I should say. It seems as though the Dreamliner production is going to be continuing as Boeing works to resolve the issue. They're also saying that it does not pose a quote-unquote immediate safety of flight concern for the in-service fleet, so that's definitely a relief to many. Boeing expects no change to its 2023 production delivery targets for the plane, only affecting the near term. That's important because what we're looking at here in white is the revenue coming off of multi-year highs. Meanwhile, the stock, even though it's down today, up solidly on the year, so probably investors hoping that it's not going to affect it all that much. But we certainly have other related airplane companies and airplane supplier companies down sharply. Spirit, they're a supplier, GE, Raytheon. So we have some weakness here. And again, Boeing under pressure itself, down more than 3%. Worst day of the year, John.
Abby, thanks for that. Looking at a 2-year flying high. 480 is the high of the session now. 480.73 right now, just short of that number. Remarkable moves in this bond market. Popping after a big move in PCE for the first month of 2023. From planes to automobiles, Carvana under pressure after reporting a bigger than expected quarterly loss. The CEO saying this: rising interest rates and market sentiment drove a significant shift in our priorities away from growth, leading to markedly lower volumes. As a result, we've been carrying excess costs. Ed Ludlow on the West Coast with more. Hey, Ed.
Yeah, good morning, Jonathan. The stock down more than 12%. Only the biggest drop in a week, but a decline of more than 16% would be our biggest drop on Carvana going back to December. A loss of $7.61 per share was more than triple what the street was expecting. A sharp decline in retail sales and the profits accompanying them in the quarter spells more of the same to come. You see the numbers from the quarter there, and on the top line as well, $2.84 billion, also a miss and a big drop from this period last year. Analysts are talking about liquidity risk, and a big reason is the $8 billion of debt that Carvana carries and needs to service, right, John? A big part of this story is that $5 billion of it is in distressed territory, that most of it is rated CCC, and how are they going to service that? The CEO talking on the earnings call kind of said that he saw a path forward without needing to raise additional capital, and in the marketplace, that certainly raised a few eyebrows. But the street's reaction as a whole, John, is one of concern around liquidity and what this company does going forward. It's also a story of mismanagement. That chart for me is pretty astonishing, down 98% in 2022. The shares have rebounded at the start of this year, but a really interesting comment from our colleagues at Bloomberg Intelligence: go back and look at Hertz before the bankruptcy and what those shares did in the weeks. A similarly prolonged dead cat bounce, and that's got people really worried. Don't focus on the recent near-term performance of this stock. Look at the debt pile, and that's where the street's focused this morning.
Stock's getting hammered, down 13%. Ed, thanks for that. Elsewhere, an antitrust suit hitting shares of Adobe. The Justice Department preparing a lawsuit to block the firm's acquisition of Figma. Analysts at MoffettNathanson say if the deal is blocked, it would be a material negative for growth. More on the story with Katie. Hey, Katie.
Hey, John. Well, Bloomberg is reporting that the DOJ could file that suit as soon as next month. And of course, the logic behind Adobe buying Figma in the first place is that it would give Adobe a foothold with small businesses and everyday users. It would be one of the largest takeovers of a private software company, reportedly, that has the DOJ concerned. And Adobe shares, they're falling right now, down about 6%. Though short term, this could be a positive. Remember, when this deal was announced back in September, that $20 billion price tag, it did sink Adobe shares, but as you mentioned, MoffettNathanson and some others coming out and saying this is key to Adobe's growth. If it doesn't go through, this could definitely put Adobe at a competitive disadvantage. And that has sector-wide implications, John. Of course, software is up on the year, but compared with other types of tech, such as chips, such as hardware, it's definitely the underperformer, and today's price action in Adobe doesn't help.
Down 6%. Katie, thanks for that. Your broader equity market down more than 1%. If you are just tuning in, about an hour ago, we had more inflation data out of America. It came in hotter than expected. The inevitable happened. Equities dropped. Bonds dropped with it. Yields popped to the front end on a 2-year. We breached 480 for the first time, going all the way back to 2007. Joining us now, BlackRock's Kate Moore, seeing some silver linings in parts of tech and writing the following: we are not adding to overall equity risk, although we continue to rotate sector exposures in favorable of sustainable quality growth. After a meaningful valuation adjustment in 22, parts of tech look to fit our quality growth criteria, and we have been encouraged by solid earnings and guidance in parts of software. Kate, great to have you with us. We can talk about the tech theme in just a moment, but hot inflation, resilient growth, high nominal GDP world, where do you want to be in this equity market?
John, I think we've talked about this a couple times since the start of the year, and my inclination is always to want to look for stuff to buy and to add risk. But frankly, I think there's too much that we need to get through before we can really do that. We've been keeping our overall equity beta pretty stable, and we've, as I said before in those kind of notes, rotated some of our exposures underneath the surface. And here's the thing. There are companies that have come out of this earnings season with strong messages. They have talked to us about their cost control. They've streamlined their businesses. They have adjusted well to a higher policy rate environment, and frankly have pretty good revenue growth prospects over the course of this year, even in a slowing economic environment. And for especially some of the tech stuff, we saw multiple derating throughout all of 2022, pretty sharp and furious. And some of these companies actually look pretty good. So we're rotating a little bit more into some of those names. But in general, we think inflation is going to come in a little hotter. We saw that obviously this morning. Over the next couple months, that's going to be a headwind to equity market sentiment. And the Fed is going to continue its path of policy rate adjustment and hiking for the next 3 meetings. So, we're not in a place where we want to say we go all in, that the worst is behind us in terms of policy rate risk. And at this point, we're just picking our battles.
Okay, I want to talk about discretionary as well. John Golub of Credit Suisse was on yesterday, and he said this is perfect for consumer discretionary. Discretionary year to date has been absolutely flying. That's where the leadership has been, besides from the big rallies we've seen elsewhere in tech. What's your view on that now?
Yeah, there's some really, strong pockets in the consumer sectors, and I think that's a great observation from Jonathan. What I would note, though, is that it is not a one-size-fits-all or a one-experience-fits-all of consumer. There have been some notable companies that have done a great job of what I was talking about a moment ago, cutting costs, managing their labor expenses, kind of streamlining their businesses to upweight those parts of their businesses that will do well in a slowing economic environment, even as income growth remains pretty strong. And of course, we saw that data this morning. But it is, I think, a place where you want to pick your individual stories instead of buying the whole sector, because we're not talking about a re-accelerating U.S. economy or the start of a new and significant expansion. We all know that we have not just policy rate, but otherwise, growth concerns over the course of 2023. And so this is not a free-for-all, John.
Kate, on tech, I was very intrigued by a phrase in the Carvana press release, quote, away from growth. To what extent would you generalize away from growth to the whole tech sector? And if you do, is this a situation where most companies come back leaner and stronger? Or is this a situation where we see massive differentiation?
Yeah, I think that's a great question. One of the things that we've observed across software companies, not just the derating we talked about a little bit before over the course of 2022, was that there was a decent amount of over-hiring across tech and in software and parts of semis. And we've seen those companies get out ahead of the market in terms of announcing layoffs. So that's been really productive. At the same time, while sales cycles have extended for parts of software, and there have been some concerns around overcapacity in parts of semis, a lot of that is working itself out over the last quarter and into the next 2 quarters. And so I expect these companies are going to weather this economic and policy storm pretty well. What I've been really encouraged with is how honest the guidance was during reporting fourth quarter. You didn't get a lot of companies kind of sugarcoating the experience and really speaking to investors in a way that encouraged them that they were going to continue to trim costs on the margins. They were going to focus on smart growth, not growth at any cost. And I think that has really built up a more positive sentiment in the sector.
Okay, just great as always. Brilliant to catch up. Kate Moore there of BlackRock. Mohammed always asking better questions than me, which is why we only do this every quarter and just the one time. Talk about sugarcoating Git. This from the president just moments ago. The PCE report shows progress. More work needed on inflation. I'm going to put you on the spot now. Does the PCE report show progress?
It shows hesitant progress. I think the key issue is more work is needed. And this is not just a Fed issue. This is a whole of government issue.
It's a market issue right now. Equities down by 1.3%. Do you want to do the tease?
I do. Coming up, 1 year of war in Ukraine.
We should never forget that the main source of this uncertainty is exactly the Russian invasion.
That conversation coming up next.
we should never forget that the main source of this uncertainty is exactly the Russian invasion. And we are not saying this only because it's 1 year today, but because this invasion increased all the fragilities of the global economy.
1 year on, the US slapping fresh sanctions and tariffs on Russia. The Treasury Department writing the following: today's action further isolates Russia from the international economy and hinders its ability to obtain the capital, materials, technology and support to sustain its war against Ukraine. This coming as Ukrainian allies quickly dismiss a China ceasefire proposal. Your team coverage begins right now with AMH in London, Maria Tadeo on the ground in Kyiv. Maria, let's get to it. What's topping the agenda today?
Well, Jonathan, today obviously is a very symbolic day for Ukrainians. We talk about this 1 year mark for them. What they say is this is the one step closer to victory. And that's the thing that just comes up time and time and again when you talk to Ukrainian officials, but not just the people here. You ask them, do you believe, sincerely believe, you're going to win this war? And every Ukrainian that we've spoken with over the past 24 hours, especially coming on that train back to Kyiv from Poland, they all say yes, they have this almost blind faith that they are going to win this war. Now, this morning we heard from the Ukrainian President Volodymyr Zelensky. He was giving out medals to soldiers, reminding everyone in the country that there is a sense almost of safety. When you look at a city like Kyiv, is so protected. When you look at the west of Ukraine, we haven't seen any major attacks, but reminding everyone that the war is still ongoing, and really the situation in the east of the country is also very fragile. We're also expecting, by the way, to see or hear again from the Ukrainian president in a press conference that he's about to give to the international media. But the message overall from the people of Ukraine, in particular, just the people, the resilience they have, is this is one step closer to victory. Ukraine is still standing, and it has defied the expectations of many out there.
Anne-Marie, we've got to talk about as well China, the ceasefire proposal. We can discuss the sanctions from the United States, but they haven't made a heck of a lot of difference over the last 12 months. Walk me through what's been presented by China and the threat of China becoming involved in this war in a more direct way.
So first on this proposal, this proposition paper, Jonathan, which everyone in the West, whether or not it's a European leader in Berlin or it's Jake Sullivan last night, they basically disregarded this, and they're saying that China doesn't have a leg to stand on when they're talking about this because they haven't come out and condemned the war, and while they've engaged with the leadership in Moscow, they have not even spoken to President Zelensky. Xi Jinping has not given him a call. So they say that they are not a player that is fair and balanced when they would want to direct some sort of ceasefire proposal. But what it goes through is similar gripes we've heard from China about protecting sovereignty. One thing that is notable, and you mentioned those sanctions, fresh sanctions coming from Washington and European capitals today, Beijing is saying that those sanctions should not be enacted. They are giving basically an olive branch to try to help Moscow in terms of its economy. They also mentioned other things about nuclear, wanting to make sure that there is no nuclear attacks. This could be viewed on two fronts. One, that China doesn't want to see any sort of intercontinental ballistic missiles being used on the Russian side, but also remember, China was pushing disinformation that Russia was pushing out about the United States using chemical and biochemical weapons in Ukraine. So you really need to read this with a huge grain of salt when it comes to what China is doing. And on your second point, China potentially becoming more involved in the war, we've obviously heard from Secretary of State Antony Blinken talking about non-lethal material Beijing is providing to Moscow, but now they are concerned that Moscow will go over what the U.S. has stated as a red line, which is providing lethal material to Putin. And Der Spiegel had it last night. There's consideration for a Chinese company, which would have ties to the Chinese Communist Party, about sending about 100 drones to Russia.
And Marie, the U.S. sanctions have had some impact on Russia, but not as much as what people expected. What is stopping the U.S. from outpacing Europe and really front-loading even more whatever sanctions remain?
It's a great question, and it's difficult right now for the West, especially the United States, when you look at one aspect of the deluge of sanctions they've had on Russia. What you will hear time and time again from U.S. officials is that they want to enact the most pain on Moscow, but at the same time protect their own economies. And this is particularly prevalent today. We are marking 1 year of a war, and you see the weariness and fragility of Poles, whether it's Europe or America.
that potentially there are concerns that these leaders will not have the political backing to continue sending material support to Ukraine. So they want to make sure that they are still protecting their own economies, not to mention the most vulnerable economies in the world. You know, Latin America, Africa, countries in the Middle East that are really struggling with things like food insecurity and energy security.
Anne-Marie, appreciate it as always. AMH in London, Maria Tadeo in Ukraine, Mohammed Al-Erian alongside us. Mohammed, that does it for us. That was great.
Thanks for having
me. As always, should we leave it on a final word? What's your final word going through the next couple of weeks? What are you looking for?
I'm just going to say thank you. That's my final word.
That's your final word. No 50 basis point hike from the Federal Reserve, sticking to 25?
I think they'll do 25.
I think a lot of people on board with that view. The pressure to go 50, though, will ramp up even higher if we get a hot payrolls report in a couple of Fridays' time. This Friday, we're lower by 1.5% on the S&P 500, and yields are a whole lot higher at the front end, through 480 on a 2-year. Your trading diary up next. What a session already, 26 minutes in, we're down 1.5%. Let's see if this sticks through the session. We're down by 1.9% on the NASDAQ. The why, you know the why. An hour and 25 minutes ago, inflation data in America coming in hot, and this happening in the bond market. Yields up big time on a 2-year, through 480 briefly, up at the front end by 10 basis points, up 6 on a 10-year, 393.93. That's the price action. Here's the trading diary. Coming up shortly, new Mitch Sentiment Survey, top of the hour. Host of Fed Speak, Jefferson, Mester, Bullard, Collins, Waller, all on deck. Chicago Fed President Austin Goolsbee speaking on Tuesday. ISM Manufacturing on Wednesday. Another round of jobless claims on Thursday. And President Biden and German Chancellor Olaf Scholz meeting at the White House to round out the week next Friday. That is it for me. Enjoy your weekend from New York. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
Julie's coming.
It's 30 minutes into the U.S. trading day on Friday, February 24th. Here are the top market stories we are following for you at this hour. 1 year of war. We mark the somber anniversary of Russia's invasion of Ukraine. We're live in Kyiv as President Zelensky speaks. Coming in hot, the Fed's preferred inflation gauge delivers the wrong kind of upside surprise, unexpectedly accelerating in January. So, more repricing to do? Fed swaps fully price in rate hikes for the next 3 meetings. Stocks drop and yields climb. From Washington, D.C., I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. And Guy, it is a day in which we are marking 1 year of war on the European continent, a war that has had a massive humanitarian cost, but an economic cost as well. And we see that evidenced by the inflation data we got here in the U.S. today.
You can see the connection. It's fairly straightforward, isn't it? You roll in the pandemic as well, and you are creating quite a combination here, aren't you? The 1 year anniversary is a good time for us to think about so much of what has changed over the last 12 months, Kaylee. We've come out of pandemic. China's now out of the pandemic. We have an inflation pickup, an economy that has accelerated dramatically. We have shortages that are hugely problematic. And at the center of that shortage story is and remains the conflict that we see in Ukraine. It has changed so much, and I think it is right that we spend time, therefore, thinking about the implications, not only from a humanitarian point of view, but from a macroeconomic point of view as well. And we'll do that as we work our way through the day.
We will, and we begin now with, we're awaiting at this time a briefing from President Volodymyr Zelensky in Ukraine. And joining us now live from Kyiv is Bloomberg's Europe correspondent, Maria Tadeo. So Maria, you are there on the ground. What is the situation on the ground now, 1 year into this conflict?
Well, Kaylee, if you're in Kyiv, and this is a very particular place because it does give you the sense of safety. When you get here and we're on this train from Poland, you travel essentially across Poland and you travel across Ukraine. It's a huge, massive land, many hours on that train. Obviously, when you get to Kyiv, the first thing you see is soldiers, a lot of soldiers across the city that will check your papers, that will check your documents. There's checkpoints pretty much everywhere. We're very close to government buildings, so obviously the whole place seems almost like a fortress. But this morning, the Ukrainian president really reminding the entire country that the fight continues. And again, saying we should say thank you and be grateful to our soldiers that continue to fight. And the reason, frankly, why a year later Ukraine and even Kyiv is standing is because of the soldiers of Ukraine. President Zelensky obviously also played a role when he decided to stay in the country. For many European leaders, that was a game changer. It was a real signal that he was not going anywhere. Now, in terms of the situation this morning, well, I have to say it has been pretty quiet. There was no air sirens overnight. There is, I would not say panic or fear. That's not what you get when you talk to Ukrainian people, but some level of alertness. Maybe tonight in the next 48 hours, what that may look like, nobody knows, but there is a sense of just stay alert in case something happens. And obviously when they say something, they mean Russia hitting the country on a day like today. The one thing that to me was very striking, however, is when you look at the Ukrainian media, Ukrainian state television, they say this is 1 year on, 1 year, well, now closer to victory. That is their take on this. They've managed to stay put for a year. Victory is now closer. And that reflects when you talk to people across the street. Do you have faith in this victory? They will all tell you yes.
Maria, when does that victory come, though? And that is the key question. How long do the Ukrainian people think that this will last? How long do they think that this conflict will continue to have an impact on this country? This is the critical question that so many people are now asking themselves. We're 1 year in. How many more years potentially could this conflict go on for?
Especially also, Guy, in the context of this offensive from Russia, which NATO says you don't have to win until the spring. It's probably happening already now. When you talk to Ukrainian officials, and I'm making a difference here between officials and civilians, normal day people, Ukrainian officials say they want to see 2023 as the year of victory, but a lot of that will depend on the weapons that they get, the training that they get. We know the Leopard 2 tanks are making their way to Poland. Over here, it's also a very powerful sight when you're on the train and you see just right next to you, there's another lane that takes all of these weapons into Ukraine. That's when the war gets very real for people like us. For Ukrainians, of course, this is their everyday reality for a year now. When you ask people, however, and this is the thing that is just so incredible here, the resilience that people have, and you ask them, when will it end? Would you be in favor of territorial concessions? What about Crimea, the Donbass? They keep repeating, for as long as it takes. The price now has been so high that they really see this almost as an existential point. If it takes months or many years, it doesn't make a difference. For them, it's something bigger. It's almost the soul of the nation that's at play.
Maria, thank you very much indeed for your coverage. Thank you very much indeed for making the trip to Kyiv. Maria Tadeo in Kyiv. Let's talk about what comes next in terms of the effort that is being made outside of Ukraine. Joining us now is Bloomberg's Washington correspondent Anne-Marie Hordern. She's in London. She's just come back. Obviously, she was traveling with the president in Poland earlier this week. Anne-Marie, let's just talk about what comes next from the United States. We've seen announced fresh sanctions today. Why does the US believe that those sanctions are going to have an impact? The sanctions thus far, many would argue, that have been enacted have had they have been less than expected in terms of the impact on the Russian economy.
Well, I think when you look at the Russian economy writ large, there's obviously been an impact, but again, not as much as people expect. But that doesn't mean that it's only 1 year, right? The next 5-10 years projected, these sanctions can really start to bite even more. What is interesting about the sanctions announced today, it's tariffs on metals like aluminum. It is also expansion of the scope in the sense that they're going after, say, a Russian bank that operates in the United Arab Emirates, where there's a lot of Russians with a lot of money going and leaving. They're throwing all their money in places like Dubai. So you see them trying to expand the scope to put even more pain on not just in Russia, but the entire ecosystem around where people are starting to spread their money. And what they really want to do is also go after the future. So like the future energy technology in Russia, how do we make sure that they cannot move ahead and forward on that? So it's similar sanctions, but I think the scope is a bit larger, and they are trying to make sure that there's no gaps between what is right now enacted and like potentially what they could potentially see down the road.
Well, and of course, it's not just sanctions being put in place, Anne-Marie. It's aid as well, another $2 billion expected. And Biden has said they will continue to provide that support for Ukraine for as long as it takes, that Russia will never find victory in Ukraine. But has the U.S. clearly defined what a victory for Ukraine would look like at the point at which they would decide they no longer need to support it?
Well, the U.S. continues to say this line, which is there's no talk about peace in Ukraine without Ukrainians at the table. So when you have the likes of China coming out with this proposition plan, which they call a ceasefire, that's being admissible by many European capitals and Washington, D.C. and the Ukrainians themselves. It's a good question because many are asking what is the end in sight, especially many in Capitol Hill who want to know about how much longer are we going to the United States will continue to send billions of dollars. I think one thing that was interesting today, though, just a few moments ago, you heard from Senate Minority Leader Mitch McConnell coming out with a plan saying that the United States needs to continue funding Ukraine, needs to continue this united front with NATO, because what he says is that this is actually protecting American security. But it is a great question because the polls show 1 year on that they are losing some of that you saw originally from Americans and even in Europe of people who are saying, how long does this need to continue?
China has been cautious thus far. Does that continue?
I'm not sure if China has been cautious. Wang Yi was just there this week. They're talking about the relationship being solid as a rock. Last year was our relationship has no limits. This year is that they want to expand it. And Xi Jinping has made a number of outreaches to Putin. He's about to go to Moscow in the next few months. He has yet to call President Zelensky, which is why most people you talk to are saying that this proposal is really unfair. It's similar gripes we've heard from China.
This is the peace proposal that they put forward.
Yeah, proposition paper is what we should, and it's a ceasefire. One of the key takeaways, especially as the day the United States is announcing more sanctions, you could see the divisions just in this whole week really starting to harden, is that in this proposal, China is actually also saying that all these sanctions should be lifted. So many say that China is tipping, obviously, more towards Russia. The obvious question now is whether or not they will cross the red line that the United States has clearly talked about, which is providing lethal weapons. They see material that they are potentially discussing it. Der Spiegel says that they're in talks for 100 drones going to Russia that they would use in Ukraine. This would be consequential because the U.S. really says this is a red line, and the question is, what would the response be?
All right, Bloomberg's Anne-Marie Hordern in London. Thank you so much for your reporting from there and from Europe over the last several days. Now, coming up, we're going to turn to the other story we are watching today. The Fed's preferred inflation gauge coming in hotter than anticipated. And Cleveland Fed President Loretta Mester just said the Fed needs to do a little more. How much is a little? We'll get the markets take. Amy Wu Silverman of RBC Capital Markets is joining us next. This is Bloomberg.
I think the market and, more importantly, people in the street are starting to doubt whether the Fed can deliver the 2%. I don't think 2% is the right target for this economy. I think the best we can hope for, honestly, is stable inflation at 3 to 4.
That was Mohamed El-Erian, University of Cambridge Queens College president and Bloomberg opinion columnist, speaking in the past hour on Bloomberg Television. And that takes us to the question of the day after that PCE deflator figure came in much hotter than expected on both the headline and core. Does this mean even higher for even longer? Joining us now is Amy Wu Silverman, RBC Capital Markets Managing Director and Equity Derivatives Strategist. Amy, A, answer to that question, if you may, please. B, what would that mean for the equity market?
Yeah, look, this is a question that the derivatives market has been debating for quite some time. And I can tell you, the options market answer is that it's concerned. So one really big change, Kaylee, we saw between 2022 and 2023 is the skew that had left the market in 2022 has come back with a vengeance, meaning people are really focused on hedging downside. This is really coming kind of 4 to 6 months out in tenors, which is, where we're debating this ultimate terminal rate. And that concern that, 3 standard deviation drawdown, when we look at that measure, is up 54% year to date.
So Amy, just kind of walk us through the picture. If the market was to drop right now, how hedged relative to a normal position is the market to that downside?
So it's interesting. On a historical base, let's call it, a decade or so, the market still looks relatively underhedged. it looks far more hedged than it did, Guy, compared to 2022. But essentially what happened is people were just really underinvested. So, one thing we've said since the beginning of this year is investors came into this market underinvested, underhedged, and far more focused on upcrash. So people were really looking at the beginning of the year to participate. That's why we've seen a lot of this low quality rally in the beginning of the year. And now that has shifted somewhat because people have waded in the pool. And as they waded into the pool, they've kind of looked at their portfolios and said, I think actually there's quite a lot to protect here. On a historical level, our skew levels are still quite low.
So are you calling the end here of the low quality rally, Amy?
Yeah, look, this is something we have, I guess, a not very nice term for it. We've called it our trash basket, but essentially it's just, stocks that were the winners of 2022 who were free cash flow negative, who are net income negative, who are leveraged, names like Carvana, where you've seen this story play out. It's playing out right now. We knew all these issues were happening. These are pandemic winners that came out. They're facing this rising rate environment. They're not doing well from a cash flow perspective. And here we are with kind of the Fed ultimately potentially having to hike even more than expected. And you're really seeing that in the options. So you're essentially seeing that sentiment have gone from quite low to ticking up on an individual stock basis. And, that's very concerning. And that's why we've called for hedges in a lot of these companies.
Amy, what hasn't rallied that has surprised you? What should have gone up with this basket but didn't?
Yeah, it's funny you say that because, what I think is very telling about this market is we kind of came up with, 60 names, let's say, that kind of fit this criteria of what you would characterize as low quality. And, we sort of pointed to it a couple weeks ago. We said, look, this basket of low quality names is up about 30% year to date. That was the average return on the basket. And the question I got back was, okay, that's great, but can you tell me the names in the basket that haven't rallied enough? So it's essentially just that question, people asking for the names that hadn't ultimately gone as high. So actually it was interesting that I think this has changed now because overall the basket has started to sell off. But at the time, you did see lags in some of the cruise lines, the airlines that ultimately did get picked up as the China reopening story started to hit as well.
Amy, there's been some degree of back and forth over the last week or so around another potential Volmageddon related to zero-dated expiry of options. You say in your notes to us you don't see Volmageddon. You would describe the possible risk as more of a Volnado. Can you explain that?
Sure, yeah, I'll say two things about it. Zero DTE, zero data expiration, is essentially just options that are expiring within one day. We've seen absolutely just earth-shattering volume in these names, in particular in indices like the S&P. And so there have been calls that this will cause another Volmageddon. Now, for most folks, Volmageddon was quite a big deal if you were a levered short ETP like SVXY or XIV, which essentially, went bankrupt, had to close because of what happened in February 2018. But it was about a 6% drawdown on the market. So even Volmageddon itself was really not that big a deal for our market. But I would say it's a Volnado because it's targeted, it's not world-ending. Of course, it causes destruction in a very targeted area. But for the overall markets, I'd be far more concerned about the fact that overall longer-dated tenors of tails are rising.
All right, we have to leave it there, but thank you so much for bringing us your insight. Amy Wu Silverman, RBC Capital Markets Managing Director and Equity Derivatives Strategist. Now, just to reiterate, Cleveland Fed President Loretta Mester is speaking in prepared remarks right now on the subject of inflation after this hotter than expected PCE report. She earlier said that it shows the Fed needs to do a little more. She says she sees inflation risks as tilted to the upside. The costs of undershooting outweigh the costs of doing too much. We're also hearing from Fed Governor Philip Jefferson, also commenting in prepared remarks. He says that the supply-demand imbalance means that inflation will ease only slowly. So we'll stay on top of those for you. Now, still ahead, Adobe shares are sliding following Bloomberg's report on a looming antitrust lawsuit for its plan to buy software developer Figma. We've got those details next. This is Bloomberg.
Time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Angel Feliciano. Ericsson will lay off 8,500 people around the world in a cost-cutting measure. The Swedish telecom equipment maker employs about 105,000 people. In December, Ericsson said demand was slowing in some markets, including North America. It laid out a plan to cut $865 million in costs by the end of this year. It's a setback for Merck's pill to treat COVID-19. A European Union committee has recommended against the use of the treatment in adults. Merck says it and partner Ridgemark Biotherapeutics will appeal the decision. And Goldman Sachs says that investigations and its inquiries into its credit card business has expanded. That firm says that now other government agencies are involved, not just the Consumer Financial Protection Bureau. Last year, Goldman said the CFPB was looking into how it revolves incorrect bills and processes refunds. And that's your Bloomberg Business Flash. Guy?
Thank you very much indeed, Angel. 7:20 on the West Coast. Time to get to the startup. We're covering the top tech stories for the Bay Area and beyond. Silicon Valley starting its morning. Joining us now is Bloomberg's Ed Ludlow. Ed, let's talk about Adobe. Adobe may have a regulatory problem. My question is, are investors going to be relieved about this regulatory problem or concerned about this regulatory problem?
It's the right question. Bloomberg reported overnight that the DOJ is preparing to bring an antitrust suit for the Adobe Figma deal. One source said it could come within a month. And the shares have reacted negatively, which is curious in itself, because when this deal was first announced, there was kind of a puke from investors because they were like, this is way too much money for this deal. It's way overvalued. And so the dynamic you have in the market this morning is shares are down because actually, with time, the market's come to realize Adobe needed Figma for long-term growth, even if in the short term it put financial stress on the balance sheet and may have hit margins. So it's kind of a strange one because now that authorities are coming in, investors are saying, this is frustrating because we actually came to realize this could be a potentially good deal for Adobe long-term.
Okay, so maybe it makes sense for Adobe, this combination, but clearly the combination is worrying competition regulators. So what's the concern here from those authorities?
Yeah. So look, Adobe has a similar product to what Figma offers. It's basically a platform for website interface design. And Figma for quite a long time, and I'm sure loads of our Bay Area website development audience will kind of maybe back me up on this, they had a superior product. The argument that regulators would make is, well, Adobe's buying something they already have. However, Adobe's pushback would be, and I think we have a statement here from Adobe as well that we can show on the screen in terms of the work they're doing with regulators, but Adobe would say it's not anti-competitive because we do so much more. We have all these other platforms. You'll be familiar, of course, with Adobe Photoshop and Premiere for video editing. So that's the argument they're taking. The reaction is also how quickly this came from the DOJ, because it was only in November that they kind of made their last request for more information on the deal as part of looking at this. And so that's kind of interesting. The DOJ, if our sources are right, have moved so quickly to kind of intervene in this instance.
What is the expected outcome here, Ed? What do people think is actually going to end up happening?
The first answer is the broader environment. Is it a surprise that a regulatory body has made an action? It's not a surprise the action has come. The surprise comes in how quickly it was. Every big deal is being looked at, and this is a big deal. Adobe courted Figma for more than 2 years, we know from the regulatory filings around the purchase, and in the end they were having to pay double what was its last private valuation, so there was a significant premium. Just as you see with Microsoft and Activision, the market's basically saying, all deals are being looked at. M&A is under scrutiny in this environment. But as we just showed on the screen, Adobe are going to make the case this is not anti-competitive, but also they're working with global regulators to kind of find some solution either way. I don't think the market necessarily, or the reaction in the shares show that this is killing the deal. It's a concern, but it's not dead.
Yep. Ed, great stuff. Thank you very much indeed. Fascinating story, certainly having a meaningful impact. Ed Ludlow joining us from San Francisco. Coming up, cars, drugs and food drove US inflation higher than expected in January. We're going to look at the latest numbers and what it means for the Fed. That conversation next. This is Bloomberg.
We're an hour into the U.S. trading session, and right now, right around session lows. It just gets uglier as the morning goes on. Bloomberg's Abigail Doolittle is tracking the moves. Abigail, markets do not like that hot PCE figure.
No, they certainly don't, and we have this intraday chart of the NASDAQ 100 to show it. You can see that this index was going down into that number, but then a real slide right now at session lows. All of the indexes having the worst week of the year, but today's sell-off, it's on anemic volume, 20% below the average. This is more of a look at what's going on. The S&P 500 down 1.6%. The FANG index, those mega cap tech indexes, down 2.6% on that hot inflation report, the idea that the Fed will have to keep hiking. And then Apple and Amazon really contributing to the losses. Let's check in, though, on the chart that we've been looking at all week to see whether or not support and that 200-day moving average are holding. And right now, they actually are. It's pretty amazing. Doesn't mean that they will continue to necessarily, but here is basically the sideways to uptrend of the last 6 months. Here is the S&P 500 hitting right onto the 200-day moving average, that other level of support that we were talking about yesterday. The interesting thing is it could make, if we come off the lows, a nice apex for what's called a bull wedge, basically the pullback, a culmination of the selling action, then creating some kind of sideways action similar to what we saw at the end of December, or maybe actually a quick spike higher. Whether or not that happens, we don't know, but this chart does make the possibility for it. Now, really pressuring stocks on the day, of course, that PCE report, and take a look at the 2-year yield basically in the month of February. The pullback that we have seen in February, starting with that hot jobs report, really a repricing of risk in terms of will the Fed have to raise longer and higher than what had been priced in. Now, not surprisingly on this guy, we are going to see that we do have flows out of stocks on the week, $9 billion to be exact here in the U.S. Global stocks too. What's so interesting though, take a look at this. We have actually a flow into global bonds, and most curious to me on this week of, it feels like a risk-off week, again, the worst week for stocks of the year. Take a look at this. Cash, also money coming out of cash. So apparently, guys, going into bonds and credit, I should say also, and not into stocks.
Yep, we'll see whether or not that's the right trade, given where rates are going right now. Abby, great stuff. We'll continue to keep an eye on that 200-day moving average. Big line in the sand right now for the equity markets. Let's get back to the data and talk through the numbers. The January PCE numbers certainly showing that inflation is, from a Fed's point of view, and I guess from all of our point of view, going in the wrong direction. So let's get back to our question of the day. Even higher for even longer. We're joined now by Rabila Faruqi, High Frequency Economics Chief U.S. Economist. Rabila, what do you think the answer to that question is? Are we going higher? And when we get there, are we going to stay there longer?
Well, thank you for having me on the show. Great to be with you. You know, the inflation data certainly are not going to be welcome news for the Fed, right? I mean, moving in the wrong direction. We had an idea that inflation was going to be sticky, but, you know, I think at the end of the day, we should see a deceleration, ongoing deceleration. I think, you know, one cannot overreact to 1 month data. Having said that, though, that, you know, the Fed is still not seeing the response in the economy and in demand and in inflation that it needs to. So our base case remains, yes, they go further, 25 basis points in March and May. And then it's going to depend on the data how much further they have to go. If these inflation prints do not improve from here on out, then yes, there is a chance, and we think that the terminal rate could potentially be higher. But we're not changing our call right now based on 1 month's data.
Okay, well, there's also a longer-term question, Rabila, which is, does this kind of monetary policy transmission mechanism not work in this post-COVID economy? It's just not as effective. And if that maybe is the case, can the Fed realistically get back down to 2%?
Well, yeah, and that's the question, right? We're trying to figure out what this post-pandemic economy is really all about, and why haven't we seen more, you know, a bigger response? You know, there's been so many distortions in terms of income support for households and in terms of fiscal support for businesses that it's really difficult to sort of, you know, figure out what the impact will be. But this is the Fed's only tool. So they are going to keep at it, but they've already told us that they're going to keep increasing interest rates, and that's the only thing. Financial conditions are not really, you know, yes, today they are, but, you know, in general, what we've seen is the typical response is not there. And I think what we need to really, you know, figure out is when does that push come from households and businesses? Households in particular, they're seeing such strong support from job growth and income growth and wages that, you know, that's still supporting demand. When do we see that pushback, especially given where prices are? And I think that is going to happen. It's just not, apparent in the data with 450 basis points of tightening, but I think it is inevitable.
Rubeela, Catherine Mann, now at the Bank of England, formerly at Citi, well-known economist, was making a really interesting point in a speech yesterday. And she talks about this idea that the markets, which are forward-looking mechanisms, are already looking to the end of the cycle. And as a result of which, we're seeing rates effectively coming lower. Business, which is looking backwards, is dealing with the kind of inflation here and now. We need to almost kind of reverse that. Business needs to invest. Financial markets need to actually be pricing in higher for longer. How do you think the Fed is doing in communicating with the market right now?
The Fed has been very resolute in its message, right? Rates are going to go high, rates are going to go higher, and they're going to stay higher for longer. But the market has pushed back. We have seen a capitulation, right? Market has come down to the view. We're looking at a terminal rate now that is closer to, it's actually higher than what the Fed was expecting in December. So there has been that adjustment. It's just that the higher for longer view, that is what the markets are pushing back against. And, it's either the expectation that inflation is going to move lower, or the Fed's actions itself are going to result in recession, in which case rates will move lower. But I think given what we're seeing in inflation in that component of the core services, ex-housing, and that's going to be pretty sticky, and given what we're seeing in the labor market, I think that what the Fed is communicating is the right thing, is that there's way too much positive momentum, and to get the back, to sort of rebalance the supply and demand side of things, rates will not only move higher, but they're going to stay longer. They're higher for longer.
Okay, well, you allude to the question of the landing, Rubeela, and there's been more conversation recently about just a no landing scenario. Our Edward Harrison over on the MLive blog put out a column today saying a no landing scenario is just a delayed hard landing. How are you thinking about that?
Right. I mean, I'm not really sure that I'm convinced what this hard landing scenario actually means. I mean, if we're talking about an economy that continues to grow and inflation that just remains high, then yes, that, the Fed keeps going, and that hard landing scenario is more likely. We are still in the camp where we think that this economy can skirt a recession. We think we can, the Fed can achieve a soft landing. But, numbers like the numbers that we saw in, for January, they just make that path a lot narrower. So, like I said, I think we need to take a step back. We need to take a deep breath, and we need to wait for more information before, deciding where the path of, the economy is. It's very difficult to lay out anything right now. We're going data point to data point. We don't have the visibility that we need to set out a credible, forecast for what's going to happen this year, or even in the first quarter.
All right, Rubeela Farooqui, High Frequency Economics Chief U.S. Economist, thank you so much for joining us on this day of the Fed's preferred inflation data. But of course, that is not the only reason why this day in particular is noteworthy. We are also marking the one-year mark of the war in Ukraine, 365 days since Russia invaded. And we do see now Ukrainian President Volodymyr Zelensky briefing the media in Kyiv as we mark that somber anniversary. We will look next at what to expect as we enter the second year of this war. So stay with us.
It will be not just blah, blah, blah. I believe that will be strong, powerful partners, and will do our homework, very important homework.